I think the democratization of intelligence that AI is bringing actually will create this new consumer fintech wave.
Love it. Well, you heard it here, folks. Fintech is direct-to-consumer fintech is not dead. I 100% agree with you. Welcome to VC Uncovered, the series where we highlight the next generation of investors who move faster, take bigger risks, and build shoulder to shoulder with founders. I'm your host, Drew Glover, co-founder of Fiat Growth and general partner at Fiat Ventures. Today, I'm sitting down with David Roos, general partner at Core VC, a firm focused on the essential but often looked over systems that power our everyday lives: finance, healthcare, infrastructure, and real estate. Core doesn't just chase hype cycles, they back founders who are modernizing foundational industries that frankly can't afford to break. We talk about what it takes to win legacy-dominated markets, how to build credibility with non-obvious customers, and why some of the best venture returns come from boring categories, if you know what to look for. David, thank you so much for joining VC Uncovered. I've known you for years, been a big fan of Core Innovation. I think you guys are doing something super special, and always love getting the opportunity to dig into what you're working on and talking with someone on the team that's like really in the trenches, trying to bring a lot of this shit to life. So with that, would love to kick things off just by you telling us a little bit more about you, what you're working on at Core Innovation Capital, and then we're going to dive into some questions.
Yeah, awesome. Well, thanks for having me, Drew. And likewise, huge fan of what you're doing at Fiat, and been fortunate enough to work on some companies together that have done well with your BD arm up by their side. So yeah, really love the strategy over there. But yeah, my background, I am originally one of those few originally from Silicon Valley. So I grew up 30 minutes south of San Francisco and grew up in and around the tech scene. You know, I think there was one point in my middle school where we had the three top executives' sons from Apple all in my class. So that was kind of the scene that I grew up in. And then stuck around home, went to Stanford, studied engineering there, but actually was always interested in politics and policy, and spent the summer at the Treasury Department in DC. And while I was there, I spent part of my time in the markets room, and I just got hooked on markets. You know, really, I hate being bored. I love the fast pace. It was kind of a great mix of politics, policy, and then always was adept at math. And so, you know, it was a very quantitative business as well. And got hooked on markets, and so went to be a fixed income trader after college, and traded interest rates in New York for 4 years. Super different lifestyle from the venture world. But, you know, it was great in a few aspects. One, it was kind of like you were solving a puzzle every day. The market's changing. What's new? How am I going to react? And then two is you could make a lot of money. And it's never bad to make a lot of money. But by the end of my time there, I just, you know, was feeling unfulfilled with the job itself, you know, really sitting there every day being, all right, what is the relative value of this, you know, 4.9-year treasury bond relate to the 5-year treasury bond, and whether I want to buy and sell. I was like, all right, I don't know if I'm making a huge difference in the world just sitting here behind my trading desk. So I kind of pivoted back towards the tech scene and went to business school and a couple early stage startups. One was in the political tech space, and another was a fintech startup, actually in Nigeria. And so went over to Lagos and worked on basically the firm for Nigeria. And that's where both those companies were less than 10 people. I got hooked on this early stage environment, the power of technology, to really create change in the mass market. And then that's how I ultimately found Core. It was a kind of a combination of all of these interests: the early stage, the you know, betting on big global changing businesses, and you know, loving investing as well.
Very cool. And so you get into trading, you are on a path to make trading type of money, which it's a lot of money, right? And very different culture from the VC culture as well. Can you talk a little bit more about those things that you felt, those twinges you felt when you were starting feeling that need to make the transition away? Because I know a number of folks that have made a very happy, lucrative career in the trading space. If they're happy, who knows? But I'm curious from your perspective, what was that evolution like?
Yeah, I think what really happened was we're seeing all of this anxiety in society from a social perspective. It started in 2016, people protesting. You're seeing just research report after research report about the inequalities in society. It just felt like everyone is upset with the path that we were heading on. Um, it's becoming extremely costly for the bottom 95% of Americans. And I'm sitting there at my trading desk, really interested in the policy and the politics of it all. But at the end of the day, I was benefiting a lot from any type of volatility, and I wasn't having a difference in any of it. And so it kind of just came to a heading where I was like, there are a lot of ways to make money in life. And so I was doing one of them, sitting at a trading desk, but no one said you can't make money in venture. And
That's right.
and I realized like there's a path to make life changing amounts of money, create a ton of enterprise value, while also, you know, investing in businesses that change the world for the better. And I think that's what venture and tech is all about. And that's what really drove me to find something new.
Totally. And you talking about in the trading world, making money off of volatility and the people that are most at risk very much reminds me of, I used to work in the commercial business insurance space, specifically employee benefits. And I always got a boss that said, when disasters happen is when we make the most money. And it hit me in a similar way than what you're kind of talking about, right? Where there is a way, and this is a story that you guys, which is I think that Fiat and Core have always been close. Is like you can do good and do well, and you don't have to sacrifice one for the other. So I generally just love that as a thesis in terms of investing and also just like building a platform around it. Um, I think one thing that's also just like interesting if we kind of like move through this, and something that you brought up when we spotlighted you on VC Uncovered is your concept around an anti-mega fund. And you talking about building really strong VC platforms, especially in this AI age, that don't necessarily need to be, you know, tens of billions of dollars for you to be able to still reap the rewards of really strong financial outcomes while still making a positive impact on the world. And as you see, even if you see today, A16Z and Silver Lake are trying to buy a 80% stake in TikTok, and like these multi-billion dollar funds trying to literally move markets, where I feel like Core has done a really great job at staying at this level of venture where you catch people early to make generational businesses. And so we'd love to learn a little bit more about how you think about fund construction and why you think this like anti-mega fund theory and thought is the way to go.
Well, I'll share some breaking news. Core will not be participating in the TikTok deal. Uh, so you
You
heard
heard
it
it
here
here first,
first on
folks.
this podcast. The anti mega funds, it really has that over the last decade, venture has changed so much. And it really is over the last 5 years, even that I've been a part of it, the money is all being funneled into these massive funds. And then you have on the other side these strategic funds where Core plays, around $100 million funds that are focused on specific verticals, and can bring expertise to the table, really punch above their weight relative to the fund size. And then you have a lot of generalist funds that are kind of in between, that are struggling with figuring out where to go in this market. Um, and it's not a great thing for founders or early stage businesses. The reason being is when you have a mega fund with, tens of $billions of assets under management, that, 2 to 5 million seed round really just becomes an option bet for them. All of a sudden, they're putting in dollars, but it's meaningless to them, whereas they really just want the optionality of investing a lot more over time. And their incentive is to get money out the door, because now all of a sudden they're playing a management fee game rather than a carry game, in terms of aligning incentives around building a big business. And for the most part, ironically, it may end up working out for them, but not for those early stage founders. It seems like all of their returns right now are going to come from OpenAI and Anthropic and a few of these really large AI businesses that are, the returns from the rest of their portfolio are going to be meaningless when it comes to showing DPI in their funds. Meanwhile, for us, 100 million funds will take 20 to 30 bets out of this fund. Each one, we aim for 10% ownership, where that's a meaningful bet for us. And so you're going to get someone who is dedicated to your business. And we're not living off of a ton of management fees at our size. And so we really are banking on these businesses doing well over time. And we want to invest in fund returners. But when you're raising a 2 to 5 million seed round instead of 50 million seed round, the expectations also are drastically different. With the 50 million seed round, and then the expectations for what comes after that, you now are just playing in a different ball game, where if you aren't a unicorn or deca unicorn, you are a failure. Whereas we've had plenty of great outcomes in between. And so yeah, it's just it's a tough environment for founders. The other thing I'd say is we've seen this time and time again, where founders will take a lot of dollars from one of these mega funds early on, before they've really proven out product market fit. And if you have dollars, you're going to spend the dollars. There's very few examples. Sometimes second or third founders will be more cautious about spending those dollars, but most of the time they're going to spend the dollars. And that means, like, they're going to spend the dollars on whatever hypothesis they have around their product market fit. And so if you haven't quite figured that out, you're going to spend way too much on that first theory, as opposed to really testing and iterating around a bunch of different ideas, and then finding the idea that actually clicks, and then you can pour money into that idea. So, it's a tough market to convince founders not to take money. It's always hard, but time and time again, I've seen it work out poorly when you take too much money early on.
As a marketer, I'm someone that has witnessed many times, if you have the money, you will spend it. If you have less money, you'll get a lot more scrappy, a lot more strategic in terms of how you scale your business. So I'm right there with you in terms of being a huge proponent of smaller rounds. How can we really, really thoughtful about it? And really, let's start seeing those big rounds once product market fit is hit. Because at that point, you want to be able to walk into any VC and say, if you gave me $20 million tomorrow, I know exactly how I spend it and how I make money on it. We want to optimize for inexpensive tests to figure out what's wrong faster. And so obviously, like, Fiat is one step below core, which I think why we have such a good relationship is, when we see something that's great, we can pass it over. One thing that kind of stood out to me is also historically, smaller funds have always done better than big funds. And the biggest funds, when they were in their early years, did the best. And you made a great call. Like for a $2.5 million seed round for a $10 billion fund, it is truly an option bet. It's almost a spray and pray type of model with less money and less shots on goal. Can you talk a little bit more about how you guys are underwriting opportunities? Because obviously each shot means so much to the core's deployment strategy because you only have 20 plus of them for an entire fund. So I'd love to just learn more about how you guys approach that.
Yeah. Well, I will say, it's probably super repetitious with what other venture funds say on this podcast and everywhere, but it really comes down to the team at the early stage. I think I was listening to one of your podcasts where you mentioned that 80% of the time the idea that the founder finds product market fit with is not the idea that the pre-seed investor invested in. So you have to believe in the founder, and I look for a few different things. One is an incredible intensity of the founder. He has to be obsessed with a certain vision and not necessarily a direct path to get on that vision, but a willingness to just grind and break through walls to get there. One thing I always underwrite at the early stage is like how responsive is that founder? How compelling is the content that they're creating? Is there a track record of going super deep into this field? Those are just some because there's only so much you can learn about a person when you're spending a couple weeks with that person, but there are just certain signals you can take away from how they interact with you. So that's one. Two is being a complete magnet for attracting capital and talent. This is you have to be able to tell an amazing story to your investors, but then also to hires, especially in this environment when so much money is being thrown at at the top talent for AI. You and to convince people to take less money, you really have to be able to spin a vision and get people to irrationally believe in you. And then really looking at both accomplishments and self-awareness. I
Yeah.
want the founder to have incredible past achievements, but then also be super aware about where they need to build around themselves. And so those are like first and foremost what I'm looking for in terms of underwriting. In terms of like portfolio construction, we still want the first check we write into a company to be a fund returner. So
Mhm.
that's something we have talked about a lot over time. Is like we're not just looking for a 10x investment when we first invest. We want to see like this 1 to 4 million check can actually return the fund. And obviously that's very different than what a big mega fund will have because uh, if you're writing out of a $10 billion fund in a seed round, even if you own 20% and there's no dilution over time, you're looking at a $50 billion outcome. So this is one where I think it provides optionality for that ultimate outcome for both us and the founder.
That's great. And when you talk about talent in today's world and you think about this age of AI and all these companies saying super lean, everyone's saying it. How do I make it so I make $1 billion company at 20 employees or 5 employees? Some crazy people even say it one. How are you thinking about how founders are going to have to shift in terms of what their superpowers are? Because I 100% agree. I still believe talent is a moat. I think data is a moat. I think distribution is a moat. Distribution slash like how can you drive revenue? But talent as a moat when we're no longer living in a world where a $1 billion company has 650 employees and now it's potentially 50 or even 20. Um, and also knowing that people like Facebook are spending hundreds of millions of dollars just to like acquire a really good engineer. Um, How are you kind of underwriting founders based on how they can bring a really strong team around them that are going to get them so far in their growth journey?
Totally. And it's very ironic because you see these AI deals of AI native, AI specific companies that are raising so much money and hiring a ton. And so it's a counter narrative to the idea that AI is actually creating the ability for lean teams to get so much further. But we're seeing it across our portfolio in terms of teams just reaching milestones with smaller teams up front.
Mm.
Interestingly, it's not so much the like AI specific businesses. It's really more of the businesses that are using AI on the back end,
That's right.
but sticking with their theses and their hypotheses on the front end. And so it can be a traditional fintech company that is using AI on the background in the background to get to these milestones much faster, rather than being some like AI specific business. Um, and and so it really like it does come down to the team mentality. It's one thing we try to assess early on is one, just how scrappy is this founder? You know, questions I try to ask is time spent like really digging into the industry, getting to know the industry. What are you doing like as a founder to understand your customer? For example, we did one that was a while back that was trying to disrupt pawn shops, and he worked in a pawn shop for 6 months. Like things like that are that guy's just going to be very scrappy when he's building a business.
Yeah.
Might not work out, but like that's a very cool story. Um, and and it's also the uh where I think it's helping out a lot is kind of the generalist non-technical founder can now go so much farther.
Yes.
So it's good for all of us business school grads, just in terms of being able to now we can like generate a prototype. Still breaks on the back end, so you're going to need that engineer to come in and fix your vibe coding. But all of a sudden you can build a prototype, get in front of customers, have so many learnings before you're really spending a ton of money on the back end engineering side. And so that's where we've seen just like the prototyping, the ideation, the being a thought partner to these generalist founders has been super impactful.
Yeah. And how are you as an investor engaging with this whole AI space? And then I'll preface it with I think a lot of people, outsiders looking here, are like, okay, like every investor should be looking for the next OpenAI, the next Anthropic. A lot of times I'm saying I'm more obsessed with, I'm looking for a founder that is uh, obsessed with the problem a little bit more than, or I'd say problem market fit versus founder market fit. I think is like really interesting just because everyone can go so much further with this like advent of AI. But at the same time, how are you underwriting these founders, how they engage with AI? Because I think that this AI first mentality is kind of the bedrock of what's coming next. Is that right?
Yeah, totally. I think it's just there's so much hype around this, and I'll caveat all of this with there's absolutely no way we can just go up and to the right the entire way towards like full automation. And so I'm sure the trough of disillusionment is coming at some point, and that will be pretty painful across not just the industry, but across public markets too. Public
Yeah.
markets are being totally propped up by AI right now. So it'll touch everyone. So I'll caveat it with that, while also saying, there's a reason why every single CEO is saying this will be an integral part of our business. We just had CEOs of Fortune 500 businesses at our AGM, talking to us, and it was hard to get anything bearish about AI out of them because it's just fundamentally changing the game for how you build a business. And so I do think this is, for sure in my lifetime, the biggest tech wave that I've been a part of and probably will be a part of. Now, how I'm looking at it as an
Agreed.
investor, the foundation, there are parts of the stack that just will never make sense for us. And this is where, maybe I'm glad that those mega funds exist, because the foundational layer and the hardware infrastructure, like that's just going to require a ton of capital there. And we've seen it play out. The winners are probably already crowned. And so that's not where I want to participate. Interestingly, there's an information article that came out earlier this week where it was a breakdown of OpenAI's ownership. And don't get me wrong, I would love to have a piece of OpenAI right now. But the early investors in OpenAI now own just 2% of the business. And so you see like what it means to have a business that requires a ton of capital from a dilution perspective. Now, part of that is they sold 50% of the business to Microsoft, and so maybe they didn't need to do that in hindsight. But anyway, it just goes to show like we don't want to be investing in businesses that will require a ton of money over time, because that's not good for seed investors. And so instead, like I'm looking to stick to core theses within fintech and health tech, where I play particularly or spend most of my time. And so still looking for like really understanding a specific domain, working within, specific workflows, and then using AI on the back end. And so really still like I'm asking every founder in those first 30 minutes, what is their, unless it's obvious, what is their AI strategy? And you can tell the difference between ones that are, fundamentally building their team and the product with AI, and ones that where it's just, on the side. And we want some AI strategy with everything we're investing in.
Yeah. Obviously, I am a fintech investor, but I'd love to learn how you think about the value of being a specialized investor.
So I think it's really how you you have to, it's a competitive market, and you have to be able to to win deals. And I think it's really hard to win deals as a generalist, because at those early stages, founders really are looking for thought partners. And so where we really punch above our weight is in these highly regulated, operationally complex industries, where we've built up, not only a network over the last 15 years, and can help out on the BD and strategy side, but also, have a regulatory partner who's in all of our deal meetings, helps out the portfolio after we invest, and then just understand, we're not going to get afraid of, operational complexity or regulatory complexity, because we've been around it for so long. And in healthcare and in finance, and in insurance, this is really important to have someone who's going to be more of a long-term thinker. And so I think it's critical at the early stages to win deals like this. It also is why so many of those larger firms will, the mega firms, the Andreessens, whatnot, will have specific founders within it, or specific investors within a space. So, they have an awesome fintech team. And so you've seen like even the mega firms will have, specific experts.
Yeah, no, 100%. And you're right. Like, again, like being able to go 100 feet deep, especially in this market where you have to compete for just about every single deal you touch. That's the added value. That's the capital plus something else, which is just like so needed. Uh, I want to go back a little bit to talking about qualifying impact in your investment strategy. Obviously, we run venture funds. We are optimized for returns, not just for our LPs, but also ourselves. But um, the do good part of this is really important, especially in terms of how you're kind of thinking about it. And I'm curious how you are underwriting that as you are entering a conversation around, I want to invest in this company, this founder, this business. How are you tracking that?
So first and foremost, as you mentioned, we're a venture fund, and so we are looking for an investment that can return the fund. So if it's not something that has a sustainable business model, we're not gonna give it another look. But yeah, at the end of the day, I view it kind of, he's become controversial, but kind of how Elon does it. Like he has seemingly unlimited amount of time, but even he has to pick which areas he really wants to focus on, and punch above his weight. And so, he was the impact that he wanted to have was getting to Mars. So he started SpaceX. He wanted to disrupt banks, so he started PayPal, or what became PayPal. Um, and so, he really has had, like, he's probably the most mission driven founder and the best entrepreneur of our generation. Uh, and that's, we similarly take a focus on how do you unlock wealth and health for the mass market. That is our big impact area. And we started off back in the day with the idea of financial freedom for the masses, mainly for the un and underbanked. What we realize is that it's not just the un and underbanked that are financially insecure. It's actually the 95% of Americans that are financially insecure in some way. And so we really focus on that mass market. And then we also came to believe, or came to realize, that financial wellness isn't just about financial services, but it's about the entirety of household GDP. And so we now look at those other operationally big trillion-dollar markets: healthcare, housing, small business enablement, things where, you can really, if you create massive enterprise value, you're also going to be able to move the dial on people making money or spending less money. So that's where, we look at alignment on that business model and impact from the get go. And then in terms of quantifying it, it's always helpful to have a goal. We encourage our founders to have KPIs front and center on their board decks, and so obviously we have to have that as well. And so we have this right now $1 trillion metric of, so, you have BPI on the financial side. On the mission side, we have this $1 trillion metric of how do you create $1 trillion of net new worth for everyday people.
I love
And
that.
obviously, there's as much art as science. We don't want to be overly burdensome to our founders, and so really, like, we are just using KPIs that are core to the business. It's where alignment comes down again. Um, but we focus on, how much money are they saving, how much money are they helping people earn, and then also on kind of have a risk metric in terms of how are they smoothing over risk. And then it's not just on the what becomes a little bit more complicated about the metric is it's not just on the direct side. Probably 25% of our portfolio is on direct to consumer, but about 75% of our portfolio is on the infrastructure side, mainly because we believe, in scale. And if you want to have massive scale, you need to modernize back end financial infrastructure, back end healthcare infrastructure in ways that increase access and affordability on the front end. And so yeah, every year we do an audit to figure out how much money have we saved. This year, the cumulative number is around $325 billion over a 15
Wow.
year time span, which is
Incredible.
quite incredible. And there's heavy correlation, by the way, between companies that are doing incredibly well on the financial side and saving people a lot of money. And so that's the number right now. We aim to get $1 trillion, which we thought was going to take another decade. It actually, on this pace, will take another 5 years, and then we're going to have to shift the goalpost. So maybe instead of $1 trillion cumulatively, we can start to look at $1 trillion annually, and that's where, you're really changing society.
I love that you guys wrapped it around a number. I feel like a lot of folks, when they talk about impact, it's just like, all right, year ended, let's figure out where we landed. But they're not really working towards a specific number. That $1 trillion number is astronomical when you say it out loud. But again, you started 15 years ago, like 15 years in, that's attainable. And I'd love that you guys are going to be hopefully, knock on wood, moving that goalpost soon. One other piece that you talked about was how, around 25% of your portfolio today is direct to consumer. The 75% of it is infrastructure. I feel like right now we're in this like infrastructure era. Like if you talk about where the wave is, it's within infrastructure. Where the wave has seemingly died off of it is direct to consumer fintech, less so health tech, but really fintech. Um, do you think that direct to consumer fintech is, I'm going to be really provocative here, dead or very much alive?
It's a tough question. I think it will look very different in this next wave than it did in the past. But I guess if I had to pick an answer, it's very much alive. You look at the businesses that have gone public and succeeded, and consumer fintech dominates those outcomes. You look at Chime, you look at Robinhood, Coinbase. Some of the largest outcomes have been in consumer fintech, and that's happening this year as well. And then if you look in our portfolio, some of the best performing companies attain PayJoy, Kickoff, they're consumer focused businesses that have reached this profitable growth trajectory and are truly crushing it. And it's interesting to see because there's been, the last few years for consumer fintech were so negative, and they just, kept grinding through it and now have really reached a scale that's incredible. Um, Now I think that consumer fintech is going to look a lot different than it did, a decade ago when Chime got started. The first consumer fintech when it started was really like, how do we digitize banking? And incumbents were moving super slowly, so you really could just build like a nicer UI and get away with not doing much on the product side.
That's right.
And I think for the next decade, incumbents now have completely woken up. And so I think I think you're going to have to work in and around and with incumbents. And so it's not, I don't think like a new neobank is coming. But I think AI has kind of created this new jolt in user experiences that you can create. So we've been talking about it forever. This idea of automated finance. Finally, the tech is there for that, and it's going to come in a lot of different ways. I think wealth management is a super interesting area where you have what was previously for the top 1% of both consumers and businesses in terms of the services that could be provided. Now you can totally bring that down to the bottom 99%. And so that's going to come in both like augmenting advisors, but also building a newer type of consumer fintech. And also for the micro SMBs, like in terms of, the services that could be provided from an investment bank for massive businesses. Now you could do that for a micro SMB. So I think the democratization of intelligence that AI is bringing actually will create this new consumer fintech wave.
Love it. Well, you heard it here, folks. Fintech is direct to consumer fintech is not dead. I 100% agree with you. It's like we're in this personalization era where like finally your bank, your money management tool is going to know more about you than you know about yourself, and they'll be able to instinctively understand what's coming next in your life. So the things that you'd have to be like, do I need a 529 for my kid? It's like, I know your birthday, I know you're married. I saw based on your purchase history, like you guys are buying diapers, you just bought a crib. Like, let's connect the dots for you here, right? So, I think it's a really exciting time for direct to consumer fintech. I think it's still before its time in terms of the rest of the world figuring out like when it's going to become alive again. But I think, folks like us that are so close to it, so close to the ground, it's starting to bubble up again, which is really exciting. Dude, this has been incredible. I want to finish off the way I typically finish off, was just a couple of questions that I've basically written down throughout the process of our conversation. So they're quick, kind of like quick hitters. Feel free to take as short or as long on all of them. The first one is probably going to be a slightly longer answer, but you grew up in this very, call it, I don't know, privileged world to like grow around like some of these like, Apple executive kids. How was your early network? How has your early network affected your network of the present?
This is a still a difficulty of venture right now, is that it is a very closed ecosystem. And as much talk as there was about opening it up, I feel like 2020 and 2021, there was a lot of talk. It still is very closed and network driven. And there is certainly an advantage to having a network. I did grow up in a privileged background. I went to Stanford and Harvard business school, and as much crap as is spoken about business school, so many of my friends are starting businesses or in the venture world, and your deal flow is based a lot on your network. And so the Harvard and Stanford backgrounds certainly help a ton, as cliche as that is. So maybe AI will help that over time. Like we're definitely investing in automating sourcing tools, and maybe there's a world in which that network becomes a bit less valuable as you can just start to source businesses digitally. But still, there's such a face to face and network driven part of this business that it's a huge part of life. And yeah, it's not quite fair, but it is how venture and early stage investing works right now.
100%. And network or not, even experiences give you a leg up. I mean, I grew up in a underserved community in Deep East Oakland, and that experience gives me the ability to underwrite deals in a very unique way. So it's privilege all around. Like privilege isn't always one way.
Mhm.
But I think that's a really valuable insight for all you folks questioning business school, right? Like at the very least, you're coming out with a killer network. Here's another one for you. You came out of college initially wanting to get into the political space. If you were coming out of college today with the way you thought about politics then, would you still enter it based on today's political climate?
Well, I definitely never wanted to run for any office, and I still definitely never want to run for any office. I've been a part of campaigns. I worked for a campaign for Max Rose, who was running for Congress on Staten Island,
Nice.
and it is the worst job possible. Like you are just constantly fundraising, grinding, knocking on doors, and half of the population hates you. So I have no interest in that. On the other hand, I do still think you work on the most interesting problems in society. And so, in terms of potentially working in policy one day, and you know, I don't love everything that's come out of this administration, but what I do like to see from a broader lens is that there is starting to work with Silicon Valley. I expected it from a different administration, but um, I think the ability of being able to work on the biggest issues in society and really like move the needle, I think that's a really fun part of policy.
Truth. Truth. Last question here. Core innovation. You guys really focus on wealth and health. If you had to choose to invest in wealth or health, one or the other, for the rest of your VT career, which one would you choose?
It's a trick question because they're tied together. So I mean, I would choose wealth because
It's
health
true.
is very much a part of that. There's so much of your wealth that is tied to your physical well being.
Truth. Yeah. I think wellness and fintech are definitely at I think that's going to be uh a big trend that we're going to see in direct to consumer in this next wave is the intersection of actually wealth and health. So that's super exciting. David, it's been such a pleasure. Thank you so much for joining. Again, huge fan of you, and these insights were super invaluable. Excited for everyone to learn more about you, and appreciate the time, brother.
Cool. Thanks a lot, Drew. Always fun.
This season is supported by Silicon Valley Bank. For decades, Silicon Valley Bank has been a true partner to the innovation economy, helping both founders and funders grow. Silicon Valley Bank, a division of First Citizens Bank, member FDIC. Please note, this podcast is for informational purposes and not investment, financial, or legal advice. The views expressed are those of the speakers and do not necessarily reflect the position of Silicon Valley Bank.